Hello, everybody, and welcome. Welcome to the latest edition of the Real Estate Luminaries series at the McDonough School of Business. My name is Ed Walter, and I am the Steers Chair at the Steers Center for Global Real Estate at Georgetown's McDonough School of Business. We are very proud of this event, as it is our annual on-campus gathering that allows us to highlight the strength of the real estate program at McDonough. It's also an opportunity for all of us to come together as a real estate community inclusive of students, alums, parents, and friends of the school. We are pleased that you have joined us for tonight's event. I would like to say special thanks to HFF for being our lead sponsor again this year, and thank you also to CREFC for their supporting sponsorship. Their collective support makes tonight's event possible. As I'm sure we can all agree, the world is an interesting and volatile place these days, and there are certainly obvious and direct implications on real estate. And continuing advances in technology are also having an impact across all industries, including ours. I couldn't think of a better venue and a better group of people to give us insights into our future. I know we have a fantastic program tonight, so let's get on with it. I'd like Professor Matt Seifer, who directs the Steers Center, to go ahead and start our panel discussion.
All right, Ed, thank you very much. All right, everybody, thanks for being here. How many students do we have? Hands in the air. How many students here? All right. Great. Thank you for coming. I appreciate it very much. My students will get the extra credit for attending, so I appreciate that very much. So my name's Matt Seifer. I'm the director of the Steers Center, the Atera Kaufman Professor of Real Estate at Georgetown. This is the best day of our year, and we're so happy to be sharing it with you. I'm pumped about the panel we have here. We have a great lineup for all of you today with Debbie Kafara and Roger Orff. And so, the way we're going to run this is I'm not big on reading bios because everybody has a program, so we can jump right to it. But what I wanted to do very quickly is, as I was thinking about this panel, I really wanted to talk about technology in a way that's maybe a little different than what we're used to. I think we hear about big data all the time and all those sorts of things, and they're very relevant. But what we tried to do with this panel was to introduce some spin on that a little bit so that we can get a sense for what other areas of technology are influencing real estate. So I think we have a great panel here. So to my left, we have Hossein Fateh, who is the CEO of Cloud HQ. But before that, he was the CEO of DuPont Fabros Technology. Some of you might have heard of that fairly large company. To his left is Saleh Romeh, who's an '88 alum of Georgetown, and his son Adam will be starting here as a freshman in the fall, which I'm excited about. Saleh is a managing partner at SoftBank on their Vision Fund. And to his left is Matt Barnard, who is the CEO of Plenty, which is a vertical farming company, which I'm very interested in learning more about. So guys, thank you so much for being here. I really appreciate it.
Thank you.
All right, so let's get started. Just very quickly, if you could give a little bit of background in terms of your own personal background, help the audience get a sense for who you are, where you're from, and each of you has a proclivity, well, I know you two, for sort of going long in the tooth. So let's be kind of succinct and short here. So give us sort of where you're from, sort of just a little profile of you, and then maybe lead us into how you got into the position that you're in right now. So we'll start with you, Hossein. Go ahead.
Great, thank you, Matt. My name is Hossein Fateh. I'm originally Iranian. Was educated in the UK. Came to America 30 years ago. Didn't have a green card. I should be a poster child of why they should give Iranians green cards, as opposed to what's going on now. I formed DuPont Fabros Technology, originally a private company. We bought a piece of land in Ashburn, Virginia. We got a lease from Exodus Communications. When Exodus Communications went bankrupt, I told one of my partners, this is actually a license to steal. So we went around the country buying bankrupt data centers and essentially foreclosing on the infrastructure. That's the generators, the UPS. We would pay full price for the shell, but the tenants were all bankrupt. This was Cable and Wireless, this was Exodus, this was AboveNet. When the dot-com crashed, I purchased a lot of these assets. I bought on the engineers. But from a real estate perspective, those companies were trying to build a business model. We turned it over and built a real estate model. And we got longer-term leases. We made the leases triple net. They didn't even know what triple net was. And with the longer leases and triple net, then we were able to borrow. So we were able to do it with a very small amount of equity. And then when the distressed assets ran out, the companies like Microsoft, Yahoo, Facebook were coming to us and saying, can you build us a building? And we were saying, well, sign this lease and I'll build you one. So I ended up building close to 15 massive, massive data centers. And then in 2007, I took the company public. Bob and his team all invested in us. And then I ran the public company for 8 years. I resigned 2 years ago. Now I'm doing the same thing privately, which is much more fun.
Excellent. Thank you for that. Thank you for that. Soleil.
You want maybe to shorter or
I was going to
longer than
make a
that?
joke, but I don't know him that well. So yeah, maybe the over/under half.
But I
of that
do
one.
have an exception, right, which is my background needs a little bit more explaining. So you asked where I'm from. It's usually easier to tell where I'm headed rather than where I'm from. So my mother is Japanese. My father is Syrian of Saudi extraction, which is unusual in itself, but that'll explain why I'm in the Vision Fund today. I spent half of my childhood in Japan, second half of my childhood in France. As I graduated high school in France, France became socialist. I didn't really want to be a second-class citizen in France, in a socialist country, so I decided to pursue my education in the States, and lo and behold, I came to Georgetown. So it's nice to be back on campus, and to all the students out there, I was in your shoes sitting there. Thank you. Mainly for the free food, but occasionally for a bit of networking and job-seeking opportunity, which I'm sure all of you are going to be focused on. So after school, I started my career in banking. I started in the wrong part of banking. I started in private banking, got bored of it very quickly. I figured there was more to banking, so I went back to business school, not Georgetown this time, a smaller school in Philadelphia. And joined banking right in the heydays of the derivative innovation. And I think that's what attracted me to the industry fundamentally. It was the innovation that was taking place at the time, back in 1993. Great firm that I joined, Bankers Trust. It's a little bit like throwing a ball up in the air. The fraction of a second where it reaches the apex is when I joined. The firm didn't do so well. Moved over to Deutsche Bank, and then I began my career, and most of my career was focused on emerging markets. So in particular, the Middle East, other countries, of course, Asia as well. But again, emerging markets is synonymous with innovation, growth, et cetera. And that's, I think, what attracted me to the industry. So I stayed in the industry for a number of years in Deutsche Bank, then Goldman. I decided that as I turned 50, I didn't want to be a 50-year-old on a trading floor. And that's when I threatened my wife with a one-year sabbatical. This was in summer of 16. And she said, no way, go find yourself a job. And that's when I reconnected with an old boss of mine, Rajiv Misra, who at the time was working as head of structured finance for the SoftBank Group. So SoftBank's become a household name now to most of you now. And SoftBank has a long legacy of investing in technology, obviously the most famous of which is Alibaba, where Masayoshi-san spent $20 million in Alibaba, and that stake today is worth, anybody want to venture a guess, on SoftBank Group's balance sheet? $140 billion. So maybe I'll talk a little bit about kind of the Vision Fund and how that evolved, but essentially what happened was Vision Fund became the extension of SoftBank because SoftBank got constrained in terms of being able to continue making investments in the tech space. Masa had a great vision, and his vision was that the technological revolution is just beginning right now. And he's in a hurry. He couldn't wait. To the extent that the balance sheet was constrained, you either raise equity or you sell Alibaba shares, which he didn't want to do, or you wait till you delever, you de-lever. He didn't want to do any of those. So what we ended up doing was coming up with the concept of a fund. And that's how I joined the Vision Fund, and the rest is history.
So Matt, these two guys failed the first test, so we're going to maybe have higher hopes for you. So give us your background and maybe a little type.
I'll go fast.
Okay.
So my professional career, with a background as a farmer growing up on a farm in Wisconsin, I started off actually in the telecom world. So I ended up running a firm that was a specialty engineering firm. We engineered, designed, and deployed the networks for the wireless carriers, companies like Verizon, Nextel, AT&T, Comcast, and SiriusXM. So I did that for about a decade. I then spent some time in private equity looking for ways to invest in water technology because of a deep passion and interest of mine to fix the water system. Turns out it's very hard to invest in an industry that has a series of distorted and irrational pricing around the world. So that didn't work out so well. And then after that, I got back into utility scale technology. I was brought in to scale a company that did cellular smart grids. So these are large ecosystems of hardware and software for electric, water, and gas utilities. And that then sold to the industry giant. And I went about looking for my next thing, and spent a good deal of time looking for a way to build a business that did not rely on the rationalization of water pricing, but still would have an impact. And as it turns out, agriculture is the industry that accounts for 70 to 80% of all water consumption on the planet. And so here I am, and we are at Plenty. We have been and are developing and deploying systems for growing crops in a very, very resource-efficient way, with 1% the water, less than 1% the land, a fraction of the nutrients, and higher nutritional value, tastes you've never tasted before, that are kind of mind-searingly good. But that's what we're doing at Plenty.
So Matt, I'm going to give you the next question. So if somebody walks into one of your farms, I mean, what does it look like? I mean, what do we, what is it just an industrial building that's racked with plants, or what?
When you walk up to the building, it looks like an industrial building. It presents as a warehouse. But when you walk into one of our grow rooms after going through a series of air baths and gowning up and washing up as if you're going into a silicon fab, you then walk into the grow rooms. And you're in rooms where the plants are growing on vertical walls, 15 to 20 feet tall. Extremely dense plant life all around you. You're kind of, you get this waft of smells. It's fresh and clean and pure. And you're really just kind of surrounded by plant life and lights and what is the perfect growing environment as created by the artificial intelligence that we've been building over time to give plants the ideal climate.
So on that, though, what I think I've read is that you're much more efficient in terms of the production per unit of whatever the unit is, right? So how can you be much more productive in terms of what you're pulling off of that in such a small amount of space?
Yeah. So what's interesting? So most of today, when I'm talking, I'll talk about fruits and vegetables, which are the first crops that we're bringing to market. We grow more crops than that, but those are the first crops we're bringing to market. And fruits and vegetables, for the most part, grow best in Mediterranean climates because they're not very photo efficient. Which means they need lots of sun, and they don't like very much heat. So one way you can think about what we're doing is we're creating the perfect Mediterranean climate, like late June, but all year long, 365 days a year. And it goes beyond that even. It's beyond what you can do outside. So we are making the plants more photo efficient by giving them an ideal recipe with respect to light, spectrum, intensity, duration, frequency, the nutrients, the CO2, the temperature, the humidity. So it's the first time humanity's ever had the ability to fully control the environment, and that is what has enabled us to make the plants more photo efficient and then drive incredible yields from a small footprint where we're getting up to 350 times the yield per footprint of linear space.
Awesome. So I'm going to actually go to Hossein for a minute here. Hossein, you know, when you look across all the real estate products, I mean, trying to identify an investment that has true tailwinds is maybe a little more challenging than it has been. But when people think about data centers, there's a nice sort of tailwind at your back in the way of just the proliferation of data. We think about this Internet of Things and autonomous cars and all this data that's going to come about. Can you talk a little bit about those tailwinds and how that influences your business?
They're absolutely massive. I'll explain it this way. In 2001, first of all, 80% of the market is 5 companies: Google, Facebook, Microsoft, Apple, Amazon. That's 80% of the market. So all of those companies are very good credit. In 2001, I signed a deal in one of our data centers with one of those companies. It was 3.5 megawatts of IT load. That was the biggest deal of the year. That deal was, and 1 megawatt of IT load is 100 racks, right? Each rack is 40 servers, right? So you can do the math. In 2016, I signed the biggest deal of the year for 35 megawatts of IT load. So it moved a decimal place. And what I said then is that next decimal place will move in 5 years from 2016. So it's happening now. I just signed another deal 2 weeks ago, 72 megawatts of IT load, with expansion of an additional 72 megawatts. So it's really in 2021, I predict we'll be doing 350 megawatt deals.
And what's driving that? I mean, what's really driving that growth?
But these guys, all their Instagram, all the data, all the Microsoft 365. Don't forget, 10 years ago, everyone had a server in their office that was the back of the kitchen somewhere in their office, and you brought a Microsoft Exchange server, and you ran all your email, and it all was there. Now, all of that is in the cloud, and the IT guy is no longer there, and you don't buy software upgrades. It's all automatic through Microsoft. And then every few years, there's something new that comes along. Like in 2000 and mid-2000s, it was the search wars between Microsoft, Google, and Yahoo. A few years later, it was the games that became very, very big, Farmwell and these games. A few years after that, social media. When I first talked about Facebook, I'm like, how can a social media company need 2 megawatts of servers? 2 megawatts of servers is 200 racks. How can they need that? Now they need 100 megawatts. You see what I'm saying? And 100 megawatts in each region. So now the new things that are coming along are driverless cars. We haven't even hit that. All the innovation around social media, like Instagram, has become so massive. So all of that. Look at WeChat in China. They pay. I'm only servicing the U.S. companies, but in China you can go out on a date and you only carry your cell phone. You can pay for the bills. You can contact everyone. You don't even need to take a wallet. In Japan, you pay for the taxi by just putting your cell phone in right in the center, and you take it off, and you've automatically paid. All these transactions, all of that, live somewhere, and they live in someone's data center.
So, Soleil, so I've always admired your role because I think you sit at a very interesting place on the investment committee for the Vision Fund. So you're looking at the most cutting edge technologies every day, and you're constantly getting people pitching you ideas, and you've made a meaningful investment in Plenty. Can you I mean, can you talk about what that investment committee environment looks like? What are you seeing? What's interesting? What's over the sort of the horizon of technology?
Sure. Let me share some of the insights there. I mean, the first thing we look for is we look for big underlying businesses or markets where technology is about to play a big role. People hear the word disruption. I think that's a fair term to be used in most sectors today. So the big sectors, obviously real estate is a massive sector, partly because of all the inefficiencies that many segments of real estate still engender. You know, whether it's in the broking, whether it's in the insurance that's associated with it, in the construction, for example. There's a lot of inefficiencies that technology is now able to overcome. What Hussein's saying was very interesting in the sense that we live in an age of data. Data has become ubiquitous, and it's that collection of data combined with the ability of artificial intelligence to process that data, which allows so many of these traditional businesses to become much more efficient. So ultimately, what we have in mind is consumers. We're trying to better the experience for consumers. So just like Matt said that his produce is going to be a better produce for all the reasons he explained, it's going to be a better experience for the consumer. So our starting point is to look at a big underlying market that hasn't been fully evolved or disrupted by technology and to look at the number one player in that segment, right? So contrary to what people think, we don't do venture. And primarily because venture is very early stage, very hard. And Masayoshi-san, the chairman of SoftBank Group and CEO, is the first to say that he's not able to pick out an early startup venture, right? But invariably there'll be number one or number two companies within that segment. And that's what we look for. The second thing we look for from the IC is we look for the entrepreneur that's behind the idea, right? And Matt is a perfect example of that. Someone who's got a vision, someone who's got the belief to push the company to take risks and to take it to the next level. Why? Because Masa himself is an entrepreneur. He is a visionary as well, so he likes that. There's always a meeting of the minds. So we get a lot of inbounds, inquiries from people. The most critical step is for that person to meet Masa to see if there's a meeting of minds. Is there a vision? And vision is important because vision is what spells or that determines strategy, right? Without vision, you can't have a strategy. And once you have a strategy, you can then implement that. But the key is to start with that vision. So we look for entrepreneurs and businesses that have an aggressive vision. Then what we do is we look at our ecosystem and we see how that company fits into our ecosystem. And what we do in our ecosystem is twofold, right? One way we help our companies is by connecting it with the growing portfolio of companies we have. Today we have a portfolio of about 30 companies in our ecosystem across all of the key sectors, right? Whether it's e-commerce, transportation, communication, health sciences, etc. There are many, many connectivities. So real estate, for example, has adjacencies with insurance, with transportation, with construction. And then with our portfolio companies, what we like to do is connect the companies and help them that way. The other way we like to help our companies is to connect them geographically. Because of the size of our fund, we've now become probably the biggest investor in each of the US, India, China, in all of these, in Europe, in each of these geographies. So we have an incredible network that we can connect our companies to. Matt and I spent lunch talking about how we can help Matt expand it in the Middle East and in Japan through JVs. So we're able to do that. That's why we create synergies. So we don't look for operational efficiencies. We don't like to get involved. I mean, typically we take 20, 30% stakes in the companies, 2 board seats, and that's how we influence it. So that's the philosophy. We like to pick the winner in a big market and then back that winner. I serve on the board of a couple of our portfolio companies, and it's always interesting to see when we're mixed in with some of the early venture capital investors that are in the board, they're focused on the cost line and the EBITDA line. So the first half of the board meeting is to focus on that cost line and that EBITDA line. And once that's over, I focus on the top line. How do we grow? Because we have the capital to help them grow. So if their ambitions match our ambitions, those are the companies that we go after. And Plenty is a great example of that. We're really proud to be involved with them.
So Matt, you had the vision that got funded by, by the Vision Fund. What is the vision? I mean, how what you're doing change the way people access food, shop for food, whatever it might be? What's that vision look like?
Well, so that vision, starting with fruits and vegetables, the world today is one where, again, these crops are grown in Mediterranean climates. There are only 5 of those on the planet, 195 nation states, 5 Mediterranean climates. California is one of those. The U.S. happens to have this intersection of relatively comfortable income on average, one of the world's 5 Mediterranean climates, and one of the world's most efficient logistics systems. So with 4% of the population, we're consuming about 30% of the fresh fruits and vegetables of the world. And in agriculture, for the 10,000 years that agriculture has been around, what people solve for first is calories, because without those, we're dead. After calories, it's protein. After protein, it's nutrients. Nutrients are a luxury. And so we are now solving for nutrients. Nutrients are hard to solve for. Some of these categorizations I'm making are a little bit, overly strict, but we'll go with it for the sake of conversation. So nutrients are hard to solve for because they're perishable. And so what we're doing is we're solving for perishability. We're getting anywhere from 1 to 6 weeks of additional shelf life off of our produce relative to what's on the shelf today. We're solving for flavor because now we don't have to solve for 3,000 miles in a truck. We don't have to solve for commercial yields in a field whose environment you do not control. So we don't grow iceberg lettuce. We don't grow better iceberg lettuce. We just grow better lettuce. We grow varieties that have never been grown commercially. They're sweet, they're citrusy, they're spicy, they're peppery. We grow strawberries that are bursting with flavor. They're not big, woody, pulpy, acidless, sugarless strawberries. They're packed with nutrients, and they have a taste that you wouldn't imagine. People say about our kale, oh my God, you need to give this a new name because all I know is I hate that stuff. But I love this. This is different. So, what we're confident in is that you've got a global industry that's $500 billion today. If you take the intersection of today's quality, not plenty quality, but today's quality with the pricing today, and you just put a Mediterranean climate everywhere in the planet outside, you'd end up with like a $2.5 trillion industry. So there's more demand being unmet today than there is demand being met, and that's at current quality levels. And then who knows what happens when you actually have strawberries that you'd eat an entire bowl of and not want to stop. So what we think is we're going to actually influence health around the world by eliminating the phrase, now you have to eat your vegetables, because now you want to eat your vegetables. And so that's going to be pretty impactful. And then not only that, but we can start to influence some of the other crops as well by developing the right seeds to be grown out in the field for the crops that we don't grow inside.
So that's great. And just to take a moment, if you have questions, you can tweet them to #SteersGlobal, and I'll be going through them, and we can ask the questions. But so Matt, I'm going to stay with you for a minute. I mean, we're a Jesuit institution, and we really think about sort of the value structure that provides. And I think a lot about that as an overlay to real estate, and food deserts is something I think about in the intersection of how that works with sort of the Jesuit value approach. Could your vertical farming help serve as a solution to that problem?
Absolutely. So food deserts are the product of both a demand condition and a supply condition. So if you think about from a demand perspective, if you are on a limited food budget, the last thing you're going to do is, if you take the numbers in the United States, 40% of what people buy at the shelf, they throw away in their home. So if you cannot afford to throw away your money, I know that's a crude way to say it, but if you can't afford to throw away your money, you're not buying perishable product. So fruits and vegetables are out of the question. And so there have actually been studies done where they took folks on food stamps and said, hey, this is going to be good 1 week later. If it's not, bring it back, no questions asked, we'll replace it. And the consumption amongst those food stamp cohorts skyrocketed. So it's not just that fruits and vegetables are the most expensive calorie in the grocery store, it's that they are perishable. And so you take away the perishability constraint and you make it fun to eat. And now the decision is different. Now I'm not thinking, oh, I need to both buy the most calories from my dollar, which starts to make McDonald's look like a lot of sense. But now I already know I should eat fruits and vegetables. Everybody knows that. We do a great job of teaching 5-year-olds that that's true. But now it's not going to be, I don't have to throw it away tomorrow. It's going to be good. So now I might buy more fruits and vegetables. So absolutely, we think we can affect food deserts because now this stuff is fun to eat. Now you're not throwing it away 3 days later. So it's going to be pretty impactful to human health.
Awesome. I'm going to come to you, Hossein. So I've been reading a little bit about just sort of mobile technology, and we're on this sort of 4G LTE is the current generation of mobile technology, but there's a lot of discussion about 5G, and that's going to have a meaningful implication in terms of how things are done and the differences of what that will allow in the world, autonomous driving for one. Can you maybe educate us a little bit on what that sort of migration is and why that's going to be relevant to us as a society and maybe the implications of real estate?
I mean, I'll tell you a funny story, just a side note. I just negotiated that 72 megawatt lease, which the construction cost is over $500 million. I negotiated most of it on WhatsApp, literally. So that's where the things are going.
Hold on, the negotiation occurred on WhatsApp?
Yes, on WhatsApp. Because, I'm dealing with the millennial, on the other side.
Right.
And we're WhatsApping each other, negotiating to lease. That's where things are going. And literally in so many African countries, in so many third world countries, the house line, many of my friends now don't even have a house line. In those countries, they don't even have a laptop. Everything is happening on their cell phones. So with real estate technology, that's changing is the sharing. That's been very new, both Uber and Airbnb. I mean, Airbnb now has a bigger market value than any of the hotels companies by itself because of this sharing. Soon, for example, we're not going to need as many parking lots with driverless cars. How do we reposition all these parking lots? What happens to all the side streets when we don't have as many cars? So all this technology, whether, without that fast cell phone, you wouldn't have Uber. You wouldn't have, people just do transactions right on their cell phones. So all of that is going to will have changes that will affect all of our lives. And that technology is where it has to be housed somewhere. It has to be housed in a data center. So a data center has really become a class of real estate.
We should exchange business cards.
I'm sure he'd like that, actually.
Yeah.
Soleil, so I'm going to come to you. Obviously, we talked about the investment you just made in Plenty, but can you talk about some other recent ones? What's really interesting and different that you can talk about publicly anyway that we should know about?
Sure. I mean, again, I'll go back to this notion that we're looking for segments or sectors in the industry that are very big. So rideshare, transportation is obviously very big. All of us need to get to work or get to school. Health sciences is massive. Insurance is another big sector. In all these sectors, right, as I said, one of the key elements we're looking for is something to change the way it's been done through technology. Hossein is absolutely right. We live in an era of data. But not in addition to the mobile device, what we're going to see is a proliferation of Internet of Things, right? All these devices are now going to start carrying chips with a modem that's able to transmit data to the cloud, right? That's what we're banking on. We believe, Masa's vision is fundamentally that the era of the mobile phone has changed the way people behave and the way people consume. The next wave is going to come from the Internet of Things that are going to proliferate in the coming years. And that's going to change the way. So to come back to your question as to the areas that we're looking for, it's in every facet of our daily lives. And fundamentally, and I think Matt summed it up beautifully, we're looking for a better experience and a better product for the consumer. That's what we're looking for. So take insurance, which is a sector that we're looking at very, very closely. If you look at insurance, there's a lot of inefficiencies in that whole insurance chain. People like to joke that insurance is something that's sold, not bought, right? It's that kind of product. It is a joke, of course, because we all need insurance. But if you look at the way insurance is originated, particularly in this country, there's a huge amount of premiums that's paid simply to brokers that are originating that business. Today, with technology, you can go straight to consumers. So if we have companies that, for example, you take a company like Compass that does, it's pretty well known here, which does real estate residential broking. You can very easily fold in an insurance app for the ability to buy insurance through that app. So you can go direct to the consumer. And if you do that, you minimize the amount of friction costs in originating that business. And then you look at the next phase of that insurance process, which is how insurance companies price insurance. Right? Insurance companies tend to aggregate all the risks, and they don't differentiate between different people. So take car insurance, for example. Because of my travels, I drive my car probably nowadays once or twice a month. It's pretty sad. And yet, I'm paying the same insurance rate as my neighbor who drives to work every day, right? So with technology, you can start to fold in usage and try to make it more user-specific and start pricing insurance according to usage, right? Pretty simple concept, but you need the data to be able to do that. You need to be able to capture the data, send the data, and then process the data. So those are kind of the segments that we're interested in. Again, it has to be something that's going to change the life of people, that's going to change the experience for people, obviously for the better, and make it more efficient by driving out some of the inefficiencies. That's the era we live in, and that's the direction we're headed in.
Perfect. So we got a Twitter question here for both Hossein and Matt. So what's the best sustainable and efficient energy source for Hossein's data centers and Matt's vertical farms?
Do you want me to go or you?
Yeah, go ahead.
Well, look, you really need, you cannot have only solar or only wind because it's not going to be sunny, it's not going to, or it's not going to be windy. You really need to look at it and have, I actually own a wind farm as well. Wind is a great first in, but when it's not windy, you would like to have solar. The burning of trash is very efficient. But really, the bottom line, you need natural gas. And we're actually very lucky here in America because the shale fields will be available for the next 30 to 40 years. And again, the shale technology that has changed the way we live will keep natural gas prices low for a very long time. So the bottom of it will need to be natural gas.
So we at Plenty are not, we don't have any religious commitment, I would say, to any one specific type of renewable energy. What we look at is the portfolio of options that are available to us and what the pricing is on those sustainable solutions. So, in different regions of the world, the answer ends up being different. In Iceland, it's different than it is in California, is different than it is in, on the Arabian Peninsula, is different, than it is in say, Japan. So, we recently hired the person who built and led the battery operations at Tesla, for example. But we expect ultimately our portfolio is going to include a pretty rich mix of hydro. We're opening a farm up in Seattle in a couple weeks that's run completely on hydropower. But hydro, wind, solar, batteries. So there's a mix, and it's all about price, so that we can bring the cost of the food down as low as possible.
Maybe, so remaining with you both, can you talk about battery technology a bit? There was another question that came in on Twitter. Just how does that, and so we'll stay with you, Matt. How does that battery technology, change what you're doing, or what do you think about relative to battery?
Well, so we're using, these are pretty battery-rich facilities, kind of like data centers are. A 3 to 5 acre farm that's growing several hundred to 1,000 acres of produce is anywhere from a 10 to 20 megawatt facility. So these are very power-dense farms, and so we're using energy throughout the day to both give the plants light and to do things like condition their environment. And as it happens, the power costs a lot less at 3 a.m. than it does at 3 p.m. And so, amongst other things, batteries enable us to perform some level of price arbitrage to make sure the energy going into the farm is as cheap as possible. They also allow us to maintain 6 or 7 nines worth of reliability in the farm by having constant power supplies such that our systems, particularly in areas of the world where power is not very reliable, which, by the way, is a pretty significant percentage of the world, so it helps us keep a reliable power supply delivered to our growing systems, as we work to run the farm.
One thing I would add to that is solar panel technology has declined tremendously, and it's made it possible. I think
The cost.
Yeah.
Yeah.
Yeah. I think what's lagging right now is battery technology. The minute battery technology starts to come down significantly, that combination of solar and battery becomes very, very feasible. I think that's what we're waiting for. We're just waiting for the battery technology to catch up.
So are you investing in any battery companies right now?
We are looking at that entire vertical, yeah.
And I'll bring up a side point just to tie. You made a point, Hussein, about how every couple of years there's this thing that happens, social media, et cetera, et cetera.
Sure.
And you're talking about industries affected by AI. We at Plenty, for example, we couldn't even exist and do what we do without artificial intelligence because we couldn't grow pesticide free, which is beyond what any field grower can do, whether they're organic or not, without artificial intelligence and ladybugs. So that's something that was impossible only 4 years ago because AI was the machine learning tools were a couple orders of magnitude more expensive to build, and they weren't reliable enough.
So what is the AI application to vertical farming?
There are several. Pest management, optimizing for flavor, breeding to get to the right variety that blows people's minds every single time they eat it. How to optimize plant health, where these plants are growing so fast in our system, we have to be able to use computer vision to see what's happening inside the plant relative to nutrient balance and that type of thing, and what it's doing with the light. So that we can, drive optimal plant health and keep them growing, efficiently.
Not to mention picking the crop too.
Sure, absolutely. Yep.
I would agree. The battery technology is really lagging, just like Saleh said. Like in my wind farm in Texas, there are actually times where you have to actually pay. So you're not receiving money, you're paying to put out your power. And the reason you don't stop the turbines is because you have a deal, it's a good tax credit deal. And sometimes you're actually paying because you can't stop the turbines. It would be terrific if you had enough batteries that you could store the power and the next day sell that power out. So it's really lagging. And same with the data centers. In the data centers, some of our data centers have batteries. Some of them have a flywheel. There's a flywheel that spins and sits in helium, so there's no friction. And that flywheel turning will keep the power on for the 10 seconds it takes for the generators to come on. So yes, please do go ahead and find us some better battery technology.
So Matt, I'm going to come back to you. So, I mean, the economics of vertical farming, do they make sense today? And if so, why isn't this massively occurring all over?
They do. The answer also changes on a crop-by-crop basis, and the answer is also changing on a crop-by-crop basis, quarter by quarter. So that it's moving very, very fast. So only a few years ago, it didn't make sense for any crop unless you were interested in buying, $40 a pound vegetables in central London or Manhattan. It is now something that we are building a mass premium brand around, so at prices that fit into people's budgets. And the reason why it's not already a massive industry, it hasn't made sense until recently. So like if you look at what Google did, Google started, I believe it was in 1998. But regardless of exactly what the year was, 2.5 years before they started, data storage costs were 2 orders of magnitude higher than the day they founded. In other words, Google didn't have a business, regardless of all of their proprietary technology and everything that they do well that gives them a competitive moat relative to their competitors. There was no business there 2.5 years before they started. Tesla, which still, if, depending on what you read and what you know, may go out of business. They, 3 years before they started, energy storage costs were 3 times higher than the day that they founded. Well, for growing inside, the cost, both one of the highest capital expenditures and one of the highest OpEx buckets for farming inside are LED lights. We have our own IP that helps us use the core commodity, which is the LED module, more efficiently than the industry at large. However, we still rely on that core module, the LED module. Those are far more efficient from an operating perspective than they were 5 years ago, and we would have had to spend 64 times more money 7 years ago to buy the same light capacity than we do today. So cartoonish 7 years ago, a business today. Across LED lighting, that's true. Cloud computing, where to your point about these step functions, now we're controlling environment. Humans have never controlled environment before, not for plants. So now, instead of farming being dictated to us in an open air manufacturing environment, we're controlling the environment. That's all happening in the cloud. So as farms get built around the planet, that's all going to be run in the cloud. So cloud computing, LED lights, machine learning, which we talked about a couple minutes ago. None of these things were economic 5 years ago, and now they all are, and so this now makes sense.
Perfect. So question on Twitter for you, Hossein. How do you expect the emergence of blockchain technology and a potential universal digital ledger, which I'm not familiar with, to affect the data load of consumer transactions and thereby data centers?
Look, I think everyone, I'm also invested in a small venture capital company. They came to me and said, we have this chip, it's going to make data processing 8 times faster. But when you think about it, that's very good, and it's happening, but that's Moore's law anyway. If you look at 8 times faster, 1 goes to 2, 2 goes to 4, 4 goes to 8, right? You're there in 3.5 years anyway, right? The technology of Moore's law is very much in place and existing. Google, Microsoft, Facebook, they may put 800 million of servers in my data center. They'll throw it all out in 3.5 years and replace it. My data center is only maybe 400 to 500 million, so they're putting almost double what I have. That's changing. That technology has been for the last 20 to 30 years going straight up. The only reason my business exists is the demand that you guys are putting on as a society on the chips is growing faster than that double. So my business is just between those two. It's the demand. Yeah. It's the reason we're growing is that the demand that the society is putting on chips is growing faster than the hardware technology.
I'll just add to that. The Vision Fund, as most people know, is a $100 billion fund. Our biggest investment in the Vision Fund is an $8 billion investment in a company called ARM. I don't know, maybe a quick show of hands. Who's heard of ARM? And yet, you know it obviously because it's part of our ecosystem. If you take your mobile phones, whether it's made, whoever it's made by, 90% of your chips on your mobile phones comes from ARM. The design comes from ARM, right? Our biggest investment is in ARM in the chips because it'll be central to that whole process. There you go. I mean, there's a commonality.
All right, so we're almost out of time. So the last one, which is always a softball, which is really my favorite question. So I'm going to start with Matt. We can work our way down here, but we got a lot of students in the audience, if you've seen, and ranging from 18 to 22 or whatever it might be. What is the one thing when you were a 18 or 22-year-old that you wish somebody would have told you, but you didn't have anybody tell you that, and it took a long time and a lot of trial and error to actually figure it out?
Pressure. I would say a couple things that I benefited from in my career is finding situations where rising tides lift all boats provide great opportunities to learn. I got some of my best education being able to slot into worlds where no one had any experience. And so the ability to learn fast and perform, that was the thing that leveled the playing field. And so to the extent that you can find industries going through great transformation or brand new industries that have never existed before that give you the opportunity to bite off as much as you can and learn as much as you can so long as you're motivated to do all those things, that's what I would say, because that's what's provided me both a lot of inspiration in my career as well as the opportunity to learn remarkably fast.
Soleil.
And this is destined for that. The question is oriented for the crowd here.
Yes.
Yeah? Okay. I have two, I guess. One is very important to follow your passions. I mean, it's easier said than done, but I look back at my career and I was in banking. Banking has its ups and downs. It's tempting always to stay within one's comfort zone. I think even for me, when I left banking, I was approaching 50 years old. Not an easy age for people to kind of change careers. But once the passion was gone, I knew that it was time to move on. And as millennials, many of you are going to be pretty mobile in any case. But I think what's important is always use your passion to drive your dreams and use that as your fuel and as your motivation. That's very important. The minute something starts to get a bit stale and where you don't have as much passion, that's when you should really question what you should be doing. I think that's one. The other one, I think, is a lesson that I learned in my career in banking, which is do not take shortcuts, especially things that would put you or the firm that you work for at risk. Right? I worked in a firm, two firms, Bankers Trust and Deutsche. Both have been in the headlines, and Goldman, which has also been in the headlines, about individuals, taking shortcuts and paying a very, very high price for that. I mean, I've literally sat next to colleagues who, for other intents and purposes, were perfectly good individuals, but decided to do things that weren't in accordance to either one's principles or compliance, for example. And they paid a very, very high price for it. It's tempting. I can see why people thrust into high-pressure situations might be tempted to take a shortcut and make an ill-timed decision or a lapse of judgment. Never let that happen. I think always stay true to yourselves, rely on honesty, transparency. I think if you follow that, you'll have long and successful careers.
Beautiful. Hossein.
Two things. One, I wish I had listened to my father more. He's generally right.
I got a 15-year-old. I'd love you to tell me too, by the way.
The second one, I learned in my late 20s, but I wish I had learned this earlier. When luck is going by, don't forget to just grab it. Don't wait, because it's not going to stay around.
Perfect. Well, if you could all join me in thanking this group.